Okay, welcome to Intermediate 1. My name is Professor De Silva. I'm going to be your instructor for the semester. Uh, I'm going to go over a few things today before we get into the chapters. Especially give you an introduction of the Intermediate Accounting 1. I'm pretty sure all of you have a basic knowledge in accounting. You took Accounting 101, Accounting 102, whatever the basic knowledge that you should have before you get into intermediate part of accounting. Intermediate accounting 1, 2, and even getting to advanced accounting gives you very in-depth knowledge of accounting. So having said that, let's get into the syllabus first. And when we go over the syllabus, again, before we get into that, remember this is online course. As what I realized that many of you have some kind of a conflict as far as the timing is concerned. I put this course on Wednesdays, 5 to 9 p.m. Eastern Time. However, I'm going to go fully online, so that I'm going to record the lecture and discuss all the materials, each unit, each chapter, and then we can discuss the problems. We're going to assign certain problems each week. Remember, this is a short session, short semester, only 8 weeks. We're going to cover a lot of material, but we have a limited time, so that I might go little faster. But if you have a difficulty in understanding the material, please send me a message, send me an email, and let me know what area that you need more attention. I can slow down, I can explain. Even if you didn't understand, let me know what area that you want me to go over again. I'm gladly go over that, even individual basis. I can explain what you did not understand. Okay, the purpose of this course is to learn, starting to learn a more complex kind of issues or theories that we're going to getting into. We're going to see as an accountant. If you want to become an accountant, so these are the basics that I would say put into foundation. Okay, all right, let's get into the syllabus now. This is the syllabus. I'm going to put only the important parts of this here, and we're going to discuss that. As I said, this is my information. Got an email address and a meeting date. It says Wednesday 5 to 9 p.m. But it's not. Since this is a fully online course, what I'm going to do is just recording and post the lecture or the video is on Blackboard, or I go to send you a link to YouTube. Okay, you can. So the best part is that you have the videos available anytime to watch and go over. Remember, end of each lecture, I will assign certain problems to work on, and those problems going to be discussed the following week. Okay, so it's make sure, and you are required to send that back to me before the discussion of the following week. Keep that in mind. It's very important. That's you get grades for doing the problems that I assign. It's like a homework or quizzes in some way or another. Okay, let's go to the next part. The course material, you're required to have your textbook. This is the information, the intermediate accounting, the 9th edition. I think they do have a 10th, 11th, whatever it is, but the 9th edition is much cheaper when you get it. That's what I'm going to use for this semester. There's nothing much change, so that you don't have to spend fortune to get the book. You have access to online, much cheaper. As doesn't matter how you get the tax. I think it is important that you have it, because I'm assigning problems from the tax. Okay, you have to have the right one. when I assign problems, I'm not going to put the problems here, but I'm going to put the question numbers or whatnot, so that, and the page numbers of the text. You should be able to go through the text and find those questions and answer them. Okay, that's very important. That's the reason. And also I'm assigning certain readings. And for this week, you are required to read the following chapters the following week. That's the only way you're going to understand better when I discuss this thing when we put a video. But either case, I think this is not a live in a classroom setting, but somehow, some way, I want you to do the problems and send them back to me to receive the proper credit. Okay. The last part of the syllabus that I'm going to go over, especially the gradings. Now, since it's online type of course, the grading criteria is different from our normal in-class type of setting. So I got 1,000 points total. So we got two exams, midterm and final, each worth 300 points or 30% of your total grade. Okay, the discussion posting, which is 200, I'm going to put certain things on Blackboard or send you some information. So you are required to respond to those postings. Okay, that's 200 points worth. And then you have a quizzes. As I said, each week you are going to get some quizzes to work on. That's worth 200 points also. In the total, you got 1,000 total points or 100%. You hope, again, don't get intimidated by these the syllabus and everything. We're going to work together to get through the semester. Okay, at the same time, you got to learn a lot of things. But I expect you to show me that you learn at the end of the day. If you didn't learn, if you didn't participate, if you didn't do the work that you're supposed to do, you're not going to get a good grade. Okay, so don't. Some people trying to cheat, which you're cheating yourself. You're not going to cheat anybody else. I have my own experience. I see a lot of people doing that and ended up with not knowing. It's not going anywhere, especially when you go into an interview. A real world, they're going to ask questions. If you don't understand the question, if you tell somebody else to do the work for you, you're not learning anything. What's the purpose of having an education, especially to get a job? I think ultimate goal. So if you're going to interview, I interview a lot of people in my real job, but they can understand very basic accounting. So they have master's degrees, but they are having trouble in answering simple questions. So if I don't want you to get into that kind of a situation, okay, learn. I'm pretty sure, I'm not saying you guys do that, but it is out there. It happens. So that's why it's very important. I want you all to learn. Okay, when you finish this course, you should have a very good understanding of the material that we discussed. Okay, we get into chapter 1 now. Chapter 1 talks about environment and theoretical structure of financial accounting. This is financial accounting that we're going to look into. Okay, so when I say environment, that's the accounting environment. Let's get into the real nitty-gritty. Okay, now we're getting into really nitty-gritty over here. The primary focus of financial accounting. What exactly we're looking? What is our focus? What's the objective to have a financial accounting? Providing financial information to various external users. Now we know when it comes to accounting, we got a different type of accounting. Financial accounting, cost accounting, managerial type accounting. Now, primarily we going to go over this semester, this topic, this class is financial accounting. So financial accounting provide financial information to various external users. Remember this one, it says external users. There are internal users and external users. Financial information is usually provided to external users. Who are they? Investors. You get creditors and other external users. I will get into that. What are external users in a minute. But external users, keep that in mind. Investors and creditors use the information to what? To predict the future risk and potential return on investments or loan before supplying capital to business. What does that mean? Investors, usually what are investors? Investors, you put the money into business as a capital. You're buying shares. If you're an investor, you buy shares of a corporation. If a corporation is not profitable, no one willing to put money into that, right? Unless, of course, you have other idea behind it, other agenda, so if you will. But in a real world, you're not putting money into a business that are not making money, period, right? So that's what it's to predict the future risk. And creditors, who are creditors? Creditors like banks who loan the money to a business. Again, the banks also want to know whether they're going to bank or anyone for that matter, maybe your personal friends or whoever it is, going to give you the money to invest in a business, okay, to buy supplies or whatever it is. It says loans, in a way of a loan. We know the investors put money as a capital, so they get a what do you call it? Stocks, okay, the shares of the corporation. What they get in return, a dividend. If the corporations or the entities are profitable, the investors get a good dividend, a healthy dividend. When it comes to creditors, it's a different story. Creditors lend money. Corporations or entity borrow money from a bank or from anybody else, but you got to return that money, right? You got to repay. So that's the loan. If you are lending money, what you expect in return is interest. That has a fixed income component, right? If you are a creditor, you're lending money to somebody, you expect him or her to pay fixed amount of interest, 5%, 10%, whatever it is. But when it comes to investors, they're not getting a fixed dividend per se. But the certain investors might get, like we are not getting into too much into that, like a preferred shareholder. So they have a fixed rate of dividend, 5% dividend, whatnot. We get into that later. Maybe in this intermediate 1 or intermediate 2, we're going to discuss in detail what those kind of investments are. Okay, keep that in mind. Financial information is a key component of that information set. Remember, it's very important to know why we have financial information. People are going to look at the balance sheet, income statement, and see whether the company is doing well, the profitable, whether I'm going to get money back. Simply, that's what it is. Okay. Okay, what is financial accounting? Financial accounting. So financial information is conveyed through financial statement. How are you going to give that information to the reader, to ultimate user, which we said external users, right? So if we are going to give money to somebody, we are looking at certain documents, especially the financial statement, which include, you can see the balance sheet, right? You know that balance sheet, an income statement, then you have statement of cash flow and statement of shareholders' equity. So a few items that you should provide when you put together a financial statement to outside parties, to external users. Financial reporting refers to the process of providing financial information to the external users. We did say that already, okay? As I mentioned before, we're getting into who are these external users or user groups. The providers of financial information, profit-oriented entities, this mainly we're talking about here in this course is the profit-oriented entities, public corporations or whatnot, or not-for-profit entities, government entities, charitable organizations, schools and such, and the household also. But again, we mainly focus on profit-oriented entities. What are the external uses? Uses of financial information. We already mentioned creditors, or rather investors, and then the creditors, the banks, the bondholders, and the other lenders. Employees also are going to look the financial information. Why? Employees are going to decide, even before you go employee, you're not going to become, you are not employees already. Still, even if you are an employee, you're going to see what's going to happen next year. If the company is going down, they know it's in the reds. For the most part, last few months, a lot of entities filed for bankruptcy. They did not survive with this pandemic, or whatever you call it, the COVID-19. So those kind of things, employees are going to look, is there a job for me next year and a couple of years from now? So they're going to look at their financials. If they're not doing well, the financial wise, so they're going to look for something else, somewhere else. That's what it means. Labor union also going to look. The customers, of course, the suppliers. Again, if you are a supplier who supply the services or the product to an entity, you're going to get, you're supposed to know, you expect to get the money, get paid. Well, the company is not paying on time, your finances not in a good way, financials are not doing good in a financial wise. So what are you going to do? You're not going to give that. You're not going to provide the services, and you're not going to send the goods. So that's one of the reasons. The government regulatory agencies, like the tax people, the Internal Revenue Service, Securities and Exchange Commission, they are the law enforcement type of entities, okay? And the financial intermediary, financial analyst, the mutual fund managers, all these type of people going to look at an entity's financial information, financial statements, whatever, however they provide. Okay, those are the people who are interested in looking at the financial information. We're going to look at there's some extra information, additional information that we throw out. The capital markets, the economic environment, and financial reporting. What is the impact on economic environment? The capital markets provide a mechanism to help the economy allocate resources efficiently. What does that mean? Capital markets. What's the capital markets? That's where people buy and sell stocks, right? So when you say provide a mechanism to help economy allocate resources efficiently, people who has money, investors, looking for investments, right? The capital market is the place people buy and sell. People who need the money, selling their stocks. People who have the money, buy them. That's what it means. That's the place to allocate resources efficiently. That's the capital market. Initial market transactions involve issuance of stocks and bonds by the corporation. Corporation receiving cash. Now this is initial offering, initial market transactions. If you are a brand new corporation putting together, or even you're being in the business, but you're going to become a public entity, the selling stocks to the public. So in that case, you're going to issue stocks. So that's what it means. You're selling stocks or bond to the public. So that's the first. That's the initial kind of transactions to get cash, the raise capital of corporation. Secondary market transactions involve transfer stocks and bonds between individuals and institutions. Corporations receive no cash. Now you can see in the initial offering, corporations is the one who issue bonds or stocks to receive cash, to raise capital. The secondary market, what happens, the people who bought these stocks originally going to hold it for some time and sell it to other people. That's the market. That's the capital market right here. The capital market does that. Okay, you just kept through the capital markets, this transaction takes place, secondary market transaction. So in that case, only cash transfer between people who are selling and buying, but not necessarily the corporation. Suppose you have originally Johnson & Johnson stocks, initial markets, they sell 1,000,000 shares to the public. Somebody took 100,000 shares. Okay, that's the initial. Then he or she holds for 3 months. Now the stock has gone up. Now that stock's 100,000. Okay, out of that 100,000, maybe he wants to sell 10,000 stocks. So that comes the secondary market. He's going to sell that stock to somebody else who are willing to spend money on buying the stocks. So the transactions between these two people, not necessarily going to the corporation. Okay, corporations acquire capital from investors in exchange for ownership interest and from creditors by borrowing. We did say that originally. Issuing stocks, corporation acquires capital, and borrowing money is another way of a corporation getting money. Okay, we're getting into some additional information here: the investments, credit decisions, a cash flow perspective. Why do investors and creditors provide cash or capital? If you have too much money, if you have money, you can invest it. That's what you do. Then you become an investor. Right? They want to earn a fair return on the resources they provide. If you're an investor, you got $100,000 sitting there, you don't know what to do with it. Right? So just what do? You just invest it. You make money. You need to earn a return. Shareholders receive cash from sale of ownership stocks that we know, right? Sale of stocks or periodic dividends. If you are the shareholder, you're an investor, you bought, say, 100 shares for IBM, Johnson & Johnson, it doesn't matter what it is. They're going to, if they buy these shares, 100 shares, they can sell these stocks, right, to somebody else. When they purchase is $50, now it is 75. So they sell, they make money. And also they get dividend if they hold the shares. You get dividend quarterly sometimes. Yeah, for the most part, the corporations, the large corporations pay dividend quarterly basis. That's the dividend, that's the return that you earn by having shares of another corporation. Two-way of receiving cash. So some people buy the stocks not for the dividend, but for what do you call appreciation. Again, $50 shares that you purchase today, you hope, you expect to increase the price and see the value of that shares to 75. Okay, so that's an appreciation. You sell, you make money, $25. Or some people are going to hold the shares without selling it for dividend. Now, I think it's better to have the stocks that corporations pay dividend. If you had $10,000, if you put it in a bank, they don't pay interest at all. Currently, very low interest, if any, maybe 0.5%, nothing. They pay nothing. But if you put that money to buy dividends of a corporation who pays dividend, or buy shares of a corporation who pay dividend regularly, that's what the financial statements give you. You look at the financial statement they provide, or annual reports. Corporation annual report provide that information. This entity pay dividend regularly every quarter. So there is a shares. You had $100, okay, $50 share. They pay $1 a quarter. Each share you hold, you own. So what is that translated to percentage wise? If you're getting $1 for $50, $2 for if you have 2 shares, right? $2 per quarter. So if you had 4 quarters, you get $8. It's not a bad deal at all. Having shares currently that pays dividends, it's a better investment, better deal than put the money in the bank. Just my thought. Some people might look at differently. So what they might say, what this stock price goes down $10, so you're not making money. Your price $50 share, now it's $40, but yeah, you make $8, but still you are in the hole, right? All different ways. Overall, you tend to see the stock goes up long run if you if you're willing to hold the shares for a longer period, for 10 years or whatnot. The shares, they usually appreciate. Okay, that's the kind of decisions you make. Key variable in investment decisions, what are this? Rate of return, how much you're going to get, like 5%, whatever it is, and uncertainty of risk. So also they might pay you higher return with what? If the risk is higher, you have to have a higher rate of return. If a risk is lower, you're willing to expect low rate of return. Let's take a look at this quick example. Very quick example. Assume an investor provide a company with $10,000 cash by purchasing stock at the end of 2017, receive $400 in dividend from a company during 2018, and sells the ownership shares end of 2018 for $10,600. A couple of things. Now you can see they purchased the stock for $10,000 and was sold for $10,600. They make $600. That's what we call share price appreciation, right? You make money. If you had no dividend at all, you still make $600. On top of that, they also got $400 in dividend from a company. So $400 in dividend plus $600 share appreciation, the price appreciation, you get $1,000, right? $1,000. So your initial investment is $10,000. What is the rate of return? At 10%. Okay, investor and creditor like to invest in stocks that provide high expected rate of return. This makes sense. Now you can pick it out. Okay, what it is. Now, what if you put this $10,000 in the bank? What rate of return you're going to get? Maybe 1%, the most, or 0.5%. Okay, think about it. If you have the money, we have to invest. Okay, that's what you learn this stuff. Okay, how about looking at this quick example? This individual purchased $200,000 worth of common stocks, received 4 quarterly dividend of $1,000 each. Now you can put the numbers here. Okay, it's important. 200,000 received 4 quarterly dividend $1,000. 1,000 times 4 is 4,000, right? You have that number, 4,000, and sold the Troman shares. What is it, Troman shares for 206,000 after 1 year. So what is the rate of return? They got the shares at 200, sold it for 22,600. So there's $6,000 you make, right? So what do you have? You get a $10,000 return, okay, for $200,000 investments, right? So if that's the case, what do? You get 10,000 divided by 200,000 gives you 5% return, right? Which is this. Number C is the correct answer, 5% return. That's how you compute the rate of return. Not just only focusing on the dividend that you get, but you have to also look, okay, what if I sell? What if I sold the shares at a certain price? Okay, I made some money too, right? What if they sell at a loss? Instead of 206,000, For whatever reason, they sold 198,000. What is the net? 198,000. You lost 2,000 by selling. That's the depreciation. Okay, not appreciate. That the share didn't appreciate. So what happens here? 2,000 loss by selling, and dividend you got 4,000, right? So net amount is 2,000. So if you are getting 2,000 for $200,000 investments, your percentage rate of return is 1%. Make sense? Do the numbers, different numbers, and you get an idea how we're going to come up with those numbers. This is very, very basic. I'm pretty sure this is very simple. Okay, when we talk about the risk and return, let's take a look at this quick example. Consider the following two investment options. Which would you pick? Assume that you're investing $10,000 in a saving account insured by the US government that generates 5% rate of return. Now you know for sure that's a guarantee that you have no problem. That's a certainty that you're going to get 5% return. But on the other hand, you also have investment opportunity in a profit-oriented entity. Suppose they're paying a little higher than 5%. But what do you think? What are you going to do? Whether you're going to go for the high return? Suppose let's say here's 7%, a little higher than 5%. But remember, there's no certainty that you're going to get it, right? It says probably, assuming, they're not saying that they're going to pay, assuming they've said just you get a 6% interest. Okay. But what if not interest? This is not talking about interest. This is a kind of a dividend type of thing. Okay. So either way, if there's no certainty that you're going to get that kind of return, you rather go with, it's not a huge difference comparing the both options. If you have too much money, you are a risk taker, put $10,000 to profit-oriented investments that pays 8%, 10%, a little higher than 5%. Okay? But if you have only $10,000, now you're not going to put somewhere else and you're going to lose it, right? So that's the think about that. When you have investment decisions, that's what you kind of think based on the different factors that you have to think. How much money do I have? What kind of risk I'm going to take? Am I a risk taker? So those kind of things. Okay. Now we're getting into the different area, the cash versus accrual accounting. Now when it comes to accounting, financial accounting, we can use a couple of ways. We can record our transactions in a few different ways. We say cash basis accounting. It's, for the most part, it's a very small mom-pop type of entities use a cash basis accounting. There are certain rules. The GAAP requires certain rules to follow when deciding which method to use. Cash basis accounting is measurement. Okay, you can see measurement of cash receipt and cash payment from transactions related to providing goods and services. Now cash basis, okay, if you're putting in accounts, you're looking only whether you receive cash or you paid cash. Okay, so getting an example, suppose you made a payment, made a sale for $10,000 sale, December 30th. The buyer said, I'm going to pay you January 5th. It's the following year. Your closing books on December 31st, right? You made a sale, but you didn't collect the cash. In that case, this is not going to be reported as sales for that year. So that's the cash basis. Okay, simple. Now, when you receive cash the following year, that's when you're going to report that transaction. Okay, that's the cash basis. Difference is net operating cash flow. Because when you use the cash basis, you have a cash receipt, you have a cash payment. The difference is your net operating cash flow, whether it's a positive or negative. Okay, we're going to look at some examples and see how that works. Now, when it comes to accrual, the two different methods, the cash method and accrual method, this is what we usually use. For the most part, the GAAP requires you to use accrual basis accounting. Measurement of revenue and expenses regardless of when cash is received or paid. Supposed to report that. You measure. Now suppose in the same example, you made a sales of 10,000 in 12/30, you didn't get the cash, but still on the accrual basis accounting, you're supposed to report that as income for that year, not when you receive the cash. Keep that in mind. Okay, now when you use accrual basis accounting, you have a revenue, rather income, and expenses. What is your, you can see the difference, cash receipts and cash payment. When you're using cash basis accounting, that's what you're going to compare. When you accrual basis, you got to call revenues and expenses, two different things, remember. Now what is the difference between these two? Regardless of when cash is received or paid, you're going to report that revenue and expenses, right? What's the difference? Difference is net income or net loss. If you have more revenue than expenses, is income. If you have more expenses than the revenue that you generated for that period, is your net loss. Okay, keep that in mind. Again, we're going to do some example, most probably at the end of the chapter. Okay, actually we do have an example here, cash basis. We can look at that. Cash basis example. Carter paid 60,000 for 3 years rent at the beginning of year 1. So on the cash basis accounting, the rent payment is shown when paid, right? That means year 1, they paid rent year 1 for total 3 years. That's year 1 plus 2 and 3. So how are you going to record that? Here's the sales. Say assume the sales is 100,000 each year. That's simple. And operating cash flows, you have cash receipts 50,000, and you got a 125, year 2 and 3, total 300. Okay. Now you can see the cash payment, cash disbursement, payment of 3 years rent, 60,000 year 1. Right, that's the cash payment right away. And then salaries 50,000 each year for 3 years. Utilities 5,000 first year and 15 and 10,000 second and third years. So if you look at that on a cash basis, what do we have year 1? Year 1 we got a loss, operating loss, operating cash flow, net operating cash flow is a negative, correct? You can see that negative. Operating cash flow 65. Why? Because we put entire 60,000 over here. Now year 2 and year 3 there's no rent, 45. Okay, when we get into accrual basis, you will see how we should put that rent payment. You got to allocate rent payment for 3 years that we get the benefit, correct? So that's what accrual basis means. You can see there's none here, there's none here. Okay, so but everything else, yes, so you got a 60,000 and 65,000 net operating positive numbers. At the end, after 3 years, you got a $60,000 of net operating cash flow. It's a positive number. Let's go to the next one now. If you go to the next one, okay, you can see that if you're using accrual basis accounting, you just allocate that 60,000 spread out for 3 years, right? Spread out 20,000 each for 3 years. It's the same thing for utilities. I think the utilities, they have for 5,000, 10 and 15. Now it's evenly. You assume utilities usually doesn't change that much unless you have a very different type of operations introduced in the different years, but utility is usually in the same ballpark, right? So it's a 10,000 first year, only paid 5,000. That's the amount they reported on the cash basis. Now if you're using accrual basis, you use not what we paid, but how much is the cost for that year. That's what happens. Okay, at the end of the day, your total net income going to be the 60,000 now, and the cash basis method, what we call net operating cash flow, right? So on the accrual basis, we call it the net income. Remember that. Okay, now we're getting into a gap. A gap, I think we learn very early, even accounting 101 and accounting 102. We know that's our Bible. Okay, when it comes to financial accounting, the development of financial accounting and reporting standard. The gap is a dynamic set of both broad and specific guidelines that companies should follow when measuring the reporting information in their financial statements and related notes. Okay, the reason being, now you cannot really compare apples to oranges, right? You have to have apples to apples comparison basis, because if you're company A uses a different method, company B uses a different, C uses something else. So how are you going to compare profitability or whatnot, right? So that's why they came up with this set of principles, guidelines. They should be able to gap facilitate decision making by investors and creditors by allowing them to compare financial information among companies. That's one of the reasons. Okay, you use the same set of standard so that we know what they are. They can compare to other companies. So that's the reason. Okay. Now, when it comes to financial accounting or the financial statements, if you are an investor or a creditor, you might not know exactly whether these financial statements or whatever the documents they put together is correct or accurate, reasonable, right? So you have no knowledge of accounting. Suppose you read the annual report, but you have no idea what they are, and you have no idea whether they are correct or not, right? It's reasonable, even if you know what accounting to some extent, but you're not sure whether they reported correctly, right? So for that reason, it requires GAAP requires that public corporations have to issue certified financial statements. What does that mean? Certified by whom? This is the CPAs, what we call independent auditors, right? So the role of an auditor, offer credibility to financial statements. So auditor is going to look at. That's an independent. They're not working for the corporation. Yes, they get paid by the corporation, but they're independent. They're going to issue a report based on their finding, based on the expertise. They look at the accounts, the financials, and say this, okay, this is reasonable. They're good. So offer credibility. So people like you and I, suppose they say we know nothing about accounting. So you can get an idea. We can read the report. The auditor's report says, okay, this is good, then we rely on that reports, right? So that's what it's offer credibility. Express an opinion on the compliance. So basically what we are looking at a compliance type of, this is a gap. You gotta look, you follow the gap. Express an opinion. Opinion right here on the compliance financial statement with GAAP. They follow GAAP. That's what they're going to. Licensed by state to provide audit services, usually called CPAs, Certified Public Accountants. That's what you're going to become, right? If you are doing, I think most of you taking this course, hoping to become an accountant. So if you go forward, you get your license as a CPAs, then you can become an auditor of a corporation. It's an independent auditor. Okay, when we talk about auditor's responsibility, we know we have to talk about the Sarbanes-Oxley Act. What happened during like 2002, 2004, somewhere around that period, we got this accounting scandals all over the place. What the Arthur Andersen is the accounting firm for these entities. What these entities did, they just simply cooked the books. That's what the word that we're using, which means they manipulate numbers. They're not making money, but they pretend, or they put the numbers, the fraud. It's a kind of a fraud, the misleading numbers, what happens? So you're not making money, but you put the accounting records to show that you're making a lot of money. In doing so, what happens? They attract a lot of investors to invest the money. Investors did. They're looking at the financials. They decide, okay, they're making a lot of money. Put some money into the business, the investments. At the end of the day, they lost a lot of money because they did not. It's not a profitable entities to begin with. So what happens? Where is the auditor's responsibility? The auditors, simply what the Arthur Andersen did. Arthur Andersen didn't want to just take the corporation CEO, CFOs, their words and put the report together and gave them a good pass. It's why they did that, because the reason they're not independent. To be an auditor, you have to be independent. What do you mean by independent? Now, are you independent? If your audit fee says 100,000, Arthur Andersen gets 100,000 for doing the audit. That's a required audit. But Arthur Andersen also provides consulting services to these entities. Consulting services generate about $2 million profit income, right? So are they going to jeopardize this $2 million for 100,000 giving real accurate reports? They're saying they're not doing a good job. They're not. So that's what happens. The greedy comes into play. These are not independent. They're biased. They issue a report without checking accurately. Somehow, this is what happens here. This increases the pressure on lawmakers to pass measures that would restore the credibility. So they came up with the Sarbanes-Oxley Act. Okay, that's what it is, this reform. Then we can go over the key provisions of the Sarbanes-Oxley Act. There's oversight board, corporate executive accountability. What does that mean? So back in the days, the corporate executives like CEOs, CFOs might say, we do not know about accounting. The accountants did that part, we just sign off financials, but they can't do that any longer. They are going to be held accountable if they sign off the financials. Non-audit services, like I said, consulting services are not allowed by the auditors. Okay, retention of work papers. So what they did, they just got rid of all the work papers. Now you have to keep them. Audit rotation, what that is. Every certain number of years, you can't keep the same auditor. You got to rotate auditors to make it independent. So you're not getting very, very friendly, very close with the corporate executives. Conflict of interest, if you own shares or stocks for that certain corporations, if you are a relative work in a higher executive type of positions in that entity, auditors should not take responsibility of auditing the financials. A conflict of interest. The hiring of auditors is the responsibility of the board of directors, and internal control is a major part of Sarbanes-Oxley Act. Sarbanes-Oxley says you have to have internal control in place for all the transactions. Okay, those are the things they came up with after that scandal. Okay, as an accountant, you are bound by certain ethics and professionalism. Ethics deals with the ability to distinguish right from wrong. If you're doing it wrong, you know what it is. You have to have a certain dignity or respect. That's why ethics comes in. You follow certain rules. You don't do bad things. Code of ethics or code of professional conducts are provided by AICPA, and if you are a management accountant, CMA, you have IMA, and internal auditors. The Institute of Internal Auditors provide that as well. Different type of professional field, they have their own kind of code of ethics. Okay, when it comes to financial information, let's take a look hierarchy, qualitative characteristics of financial information. Decision usefulness. Now, in order for you to make a proper, accurate decisions, You have to have a proper information, right information, accurate information, right? So it has to relevance to what you're looking, and paper representation is important. Now I'm going to get a little bit, the next couple of slides, we're going to go over all these items. Just go over these things. This is the basic information. Now when we talk about financial statements, what do they consist of? Financial statements include, the balance sheets, an income statement, as I said, equity, shareholders' equity part, and a cash flow statements. Okay, what do we have? Elements underneath those: assets, liabilities, equity, investments by owners, distribution to owners, comprehensive income. We get into that a little bit later in detail as what it is. The revenue and expenses, gain and losses are recorded in an income statement. Okay. When it comes to accounting, I think we learn very early in our accounting life. When you study accounting 101, accounting 102, there are a few things that very beginning we're going to learn. Underlying assumptions of the accounting financial statements. 4 basic assumptions underlie the GAAP. What are those? Economic entity. What does that mean? The economic entity assumption presumes that economic events can be identified specifically with an economic entity. We're looking at one entity, ABC Corporation. That's the economic entity. And if that entity has subdivisions, okay, manufacturing, the distribution, that's an economic entity by itself. That's what it means. Economic entity. We have to have an entity. And then we have a going concern. What is a going concern? It's an assumption to anticipate that business entity will continue to operate indefinitely. You cannot say that if the entity is going to close down next year, it has an ability to continue indefinitely. So that's a going concern. It's an assumption. So when you put together your financial, you assume that this entity going to be there for a longer period of time. And then you have something called periodicity. What is that? Assumption allow the life of a company to be divided into artificial time period to provide timely information, usually monthly, quarterly, or annually. Now, in this case, what we do in financial information for external purposes, mainly annual statements, annual financial reports. Okay. So how about the other one? It's the monetary unit. How are you going to record that information? It's monetary unit used in U.S. financial statements, U.S. dollar. Likewise, the other countries, they use their own monetary unit, euros, any other things, the sterling pounds, Japanese yen, whatever it is. That's the monetary unit. You have to report that in a certain way. Okay, people can understand. That's just all. That's the 4 assumptions that we have under GAAP. Now remember again, these are more like readings, but I still going to go over a little bit and explaining what it is. But you can read them over. I'm going to go over a little bit faster. But again, as I said at the beginning, if you don't understand some things, please let me know so I can go over again, explain it a little bit in detail if you want to. Okay. Now we got something called recognition, measurements, and disclosure concept. Recognition refers to the process of admitting information into the financial statement. The measurements is the process of associating numerical amounts with the elements. Again, your balance sheet, whatever. What's the numbers? How are you going to measure? Okay, that's what it means. Disclosure is important to also a process of including additional information in the financial statement and the company notes. Disclosure. Sometimes you put a number in the balance sheet. You put a number in income statement. That number by itself might not give a reader a good understanding what is going on, right? So it has to give some other information, disclose certain information. Okay. Assume that last year for whatever reason, you had a big fire or loss or flood loss or whatever it is, of billions of dollars. You got flood loss, $150 million, depending on the entity, how big it is. So you can just put that number, it's the loss, the flood loss, or whatever, but you have to disclose that somewhere else if it's large enough, what do we call it, material enough. So those kind of things, especially that kind of a non-operational type of event, okay, special events. So those kind of things are supposed to be disclosed. General recognition criteria, definition, measurability, relevance, all these things applies. We get to that when we do some problems. Okay, what exactly those things are. Again, the later chapters probably we're going to get into detail of this item. This is an introduction to saying, okay, what is a revenue recognition? How are you going to recognize the revenue? What is the criteria? What is revenue to begin with? It's the inflow of assets, right? Or settlement of liabilities resulting from providing a product or service to a customer. Revenue recognition used to be guided by a realization principle. You got to realize to be recognized, right? Earning process is judged to be complete or virtually complete. Reasonable certainty to the collectability. Suppose you're making a sale, okay? Earning process is judged to be complete or virtually complete. That means you provide the services, you finish whatever the project that you have. Okay, building. You're making a building for somebody, you're done. That's the earning process is complete or virtually complete. When it comes to a building, that's a different way of recognizing revenue. We get into that later. Probably you already heard that the percentage of completion method, or certain type of other methods that we're going to use. So suppose you are making a sale. You made a sale, you shipped the items, so you're done simply, right? And at the same time, a reasonable certainty as to the collectability. You made a sale for 100,000, but today you made a sale for 100,000, so you got a news. You ship the items, so it's simply you're done. You complete your earning process, right? You ship the goods to the customer, but the following day you realize that that entity went under. It's a bankrupt. They're no longer going to pay you. Okay, so in that case, it says collectability is in doubt. So those kind of things also has to be taken into account when we recognize the revenue. Okay, PASB recently issued issue number 2014. We require that we recognize the revenue when goods or services are transferred to customers for the amount to be considered and expected to be entitled to receive in exchange for the services or provided, the goods. Okay, so just the readings, you can read that over. Now, similar to revenue process, I mean, we got to provide, we got to do whatever we have to do, make a sales or provide services to be able to recognize the revenue with the subject to that collectability, right? At the same time, the expense recognition also has certain things that you got to look for. Matches revenue and expenses that arise from the same transaction. What does that mean? If you are making a sale, you are getting an income, say $100. What is the other side of that transactions? Revenue should match with an expense or related expenses. What is the related expenses? How about a cost of sale? To make that product, you have to spend money. You spend $80. That's your cost. So you got to match. You're not simply recording revenue, but not recording expenses. It's not the expense recognition. Expense recognition says that you have to match. You have to report expenses at the same period when you report your income. Okay, 4 approaches based on exact cause and effect relationship by associating expense with revenue, specific time period, systematic and rational allocation. What does that mean? Now, you remember back then, the one example we see, rent, right? When you pay rent 1 year, but the rent, we're going to use the $60,000, if you remember correctly, for 3 years. You cannot really charge entire 60,000 in 1 year. So that's what I mean, rational, systematic, and rational allocation, okay, to specific time period. So that kind of thing, prepaids, you allocate in a certain way. It's the same thing, depreciation, right? The depreciation type of thing that you're allocating in a systematic way. How about in the period incurred without regard to related revenue? Sometimes we got to do that certain things. Okay, if you have incurred certain expenses, there's nothing to match. There's no revenue to match. Suppose you hit with the fine or whatever it is. So that's an expense. You don't have any revenue to match against, right? Utilities you have you do have utility type of thing regardless of whether you make revenue or not, right? Those kind of things you just has to charge. Okay, that's the revenue expense recognition. Okay, I think we discussed about disclosure information. When we put together financials, disclosure information is important. Full disclosure principle requires that financial reports, okay, let's take a look here. The financial reports should include, let me change the color, should include any information that could affect the decisions made by external users. What that means, supposing you have a number in the financial statement, but without disclosure, additional information, you might arrive at a wrong decision. So if you have additional information, you might make a right informed decision. If that's the case, you have to have some kind of disclosed information. That's what it says. Okay, such information can be disclosed in a variety of ways. Parenthetical comments or modifying comments placed on a face of the financial statement, disclosure notes, convey additional insights, the supplemental schedule and table. Suppose you have $1 billion of depreciation expense or the rental expense or lease agreements, whatnot. They have to provide additional supplemental schedules or tables showing that information. Then this reader can get a very good understanding as to what's going on. Okay, I just run really little fast, but we discussed what is important in this chapter. Okay, and the chapters coming up, probably we're getting into more into individual area of the material. We're going to spend a little more time on the next several chapters. Now we have homework assignment. I'm going to give you, this is the homework assignment for you to do. It says do the following problems and send back to me by the end of the day next Monday the 7th. You got enough time. Today is Wednesday, so you have enough time to complete these 5 homework problems and send back to me. You can post them, and I'm going to put this stuff on a Blackboard also, but if you have trouble in accessing your Blackboard, you can email me these problems. Okay, so we're going to discuss them the next class, next week when we go over that. I'm going to discuss that as well. Okay, so that's it for now. So you make sure you read, make sure you go over these slides, especially when it comes to exam. I'm going to explain a little bit something, probably next week or so I will explain how the exam going to be, since this is a fully online type of the class. We might not have ability to go over the problem face-to-face type of, directly live type of sessions. But we'll talk about exams in a little later. Okay.